Now, back by popular demand, it's the Lance Roberts Show.
And good morning. It's Tuesday, 6:06 on our drive to work. We got a lot of stuff to get into our show today, so we're going to just kind of jump right into it this morning. Usually I spend the first segment kind of, just catching up with life, but we got a lot of important stuff going on. This weekend, well, that was the 10th anniversary of the bull market that started back in 2009. Yeah, March the 9th, 2009, a decade ago. And of course, one of the big things that were put out in the headlines across the media was, this has been a great 10 years. So if you've had any money at all invested in the stock market, you're up 400% over the last decade. Pretty incredible. And in fact, this was by far the largest bull market rally in terms of creating wealth across the country in terms of, household assets that we've ever seen in the history of the United States. Quite phenomenal. Today we have a very special report on our website looking back at the last 10 years, talking about exactly what drove the bull market over the last 10 years, but most importantly, will the next 10 years be as good as the last? See, this seems to be the actual identification here of individuals because we have what's known as recency bias. We tend to think about things in the past are going to continue to be that way in the future. But again, that's not the way really markets work. And today we have a very special report on our website looking at this very fact of this last 10 years. And it's been quite amazing, actually, all the things that we've been through in terms of the markets, and the markets have held up primarily because, of course, we know the Federal Reserve, lots of monetary interventions, lots of money printing by the Federal Reserve has been helping lift asset markets over the last years, despite really a whole slate of reasons that the market shouldn't have gone up. We've had very weak economic growth, around 2% on average for the entire decade so far, and that's not really starting to show signs of really, gaining more traction from here. But if we start taking a look at really the market itself, the one thing the market does tell us, and it's been very good about, is actually indicating both the beginning of and the end of recessions. And again, when we see these turns in the markets, and especially something that we've seen here recently, it's kind of a warning sign that we need to pay attention to a little bit about what the market is trying to tell us as a message. Because remember, the market isn't the economy. And the market is just a representation of what's happening in our economy overall. And one of the things that we're currently seeing in the market is what we call negative divergences. We see things that are occurring in terms of momentum, in terms of price action, that tell us that there may be a little bit of trouble or concern about the economy, weakness in the markets overall, are telling us those things. Now, look, we've had some great rallies here over the last couple of months. January, February, fantastic rally, big recovery off those lows of last December, but still, even with that, the market's actually gone nowhere in over a year. 15 months, we're still lower than we were in January of last year. So despite the fact we've had this really good rally here, we haven't made a whole lot of progress, and that is more indicative of kind of what's happening in the overall market as well as the economy. We're not seeing a whole lot of progress. GDP yesterday by the Atlanta Fed lowered to just 0.2% economic growth for the first quarter on the estimate. Entire year has now been lowered down to about 2% growth in the economy, kind of back to where we've been over the last decade, despite that little spurt of growth that we had last year because of 3 major hurricanes, Harvey here in Houston, 2 major wildfires out in California. It took a lot of rebuilding to get that back on track, lots of employment jobs, construction, manufacturing, but that's now all starting to kind of fade off into the backdrop. And again, when we take a look at this very long-term kind of market, thinking back to 2009, all the stuff that's happened since 2009, this market's had a very, very nice long-term advance, but even with that, we're starting to see those same types of divergences in momentum and price, things that previously have warned us about changes in the markets going all the way back to 1995. We see some of these very similar aspects of the markets, that when the markets began to go through this consolidation, or what we call a topping process, those have typically been very early indications about a change in the market environment, what's happening in terms of profit growth, earnings growth, the economy overall. And of course, those have led to, unfortunately, bigger events where, capital has been lost in the market. So while we look back over the last decade and we say to ourselves, wow, it's been a great decade, also have to remember, though, that looking back in 2009, you have to think about where we were at that time in terms of the markets, the economy. We were running $1 trillion deficit back in 2009. And of course, investors were extremely despondent about the financial market. They just lost 50% of their wealth in the financial markets. The economy was very depressed. Unemployment was very, very high back then. Jobless claims were almost 550,000 a month in jobless claims. We had existing home sales very, very bad. Of course, you've gone through the housing bust. The point here is that in 2009, everything was about really just as bad as it could possibly get. Of course, today, everything is exactly the opposite of where it was back then. Confidence is extremely high. House sales have risen dramatically. The economy is a lot stronger. Asset markets are extremely high in terms of price, also in valuation. So everything is exactly the opposite of where it was in 2009. So the question becomes exactly, what is going to be the opportunity here over the next decade for things to get dramatically better to help lift asset prices higher? So the point of all this is that while the last decade has been great, over the course of the next decade, the returns in terms of the economy, in terms of economic growth, in terms of markets, of course, wealth creation, these type of things are likely not going to be as good because simply we don't have the backdrop that is supportive of a dramatic 400% rise in prices. But this is why it's so important that as investors, we have a strategy and a discipline that simply says, this is what we're doing, this is how we're going to get there, but most importantly, a discipline to manage the risk of capital, manage the risk of markets, and understand that these things all work in big cycles. It doesn't mean we can't make money along the way, but for a lot of people that are kind of using these buy and hold strategies and just kind of riding the markets out, there's going to be a lot of people over the next decade that simply said, well, I wish I would have sold back then because it's not going to be as good in the future. We'll be right back after the break. Of course, we've got a lot of stuff to get into this morning. We've got to talk about Trump's budget. We have a special interview being launched out today on our podcast channel. We're going to talk about that with Jeffrey Sherman from Double Line Capital. Also, we've got some very interesting stories today about millennials and home ownership. All that's coming up here on the Lance Roberts Show this morning. Don't go away.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.